I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight into those burning issues. Liquidity spigots opening up in private markets as investors gird for an active start to 2020. Plus, getting ahead of the U.S. elections with a flood of deals and plenty of cash in the coffers. And $1 million hangover, why a rare set of scotches may break records in an epic sale. Time to get into those burning issues. With me, Bloomberg Sonali Basak, Natalie Wong, and Lisa Lee. Let's begin with Sonali. The WeWork saga, not that surprisingly, continues. Now with the question of who's going to finance the company as SoftBank takes control. Sonali, Goldman Sachs stepped to the plate to get a loan deal done. But there is something very unique about this deal. Please explain.
Well, for the first thing is SoftBank is the one that is working with Goldman Sachs, with WeWork as the co-borrower here. And so remember, SoftBank and WeWork have become much more intertwined since they have gotten into this deal. But really, SoftBank is really emerging here as somebody that's still somebody that many of the banks still want to work with. Remember, despite all the troubles that have happened this year, they have a big portfolio company. Something to look out for next year, for example, is DoorDash, also a portfolio company in the Vision Fund, looking to potentially go public and has worked with JP Morgan for a $400 million credit facility here.
Yeah, although SoftBank is listed as the main borrower, and I found this fascinating because they're putting their own money and their own name on the block here. How much of a liability is this for SoftBank in a broader sense? I mean, is WeWork an isolated case of them bringing it into their purview, or are they going to bring other portfolio companies also in?
WeWork right now is definitely a one-off, given how far it had fallen from its peak. And remember, it's as close as you can get to a subsidiary company of SoftBank. And so for now, it's a one-off. But if SoftBank is going to put that much of their own money at stake for somebody else, you do need to keep an eye out, I would say, on how close their other companies get to them.
All right. Well, that brings me to Natalie, because we have been seeing Amazon in particular say that it was going to come to New York, then say forget about it for HQ2, but not really. Natalie, please explain. We're actually seeing Amazon come to the city as well as a whole number of other tech companies.
Right. It's a big change from just a few months ago when Amazon announced that it was no longer coming to Long Island City. Now they've announced a 335,000 square foot lease in Hudson Yards, which shows that they're really committing to growing in New York City, even after everything that's happened. And on top of that, we had Facebook and Google continue to expand in the city. Facebook just signed a lease for 1.5 million square feet in Hudson Yards. It's going to double its presence in New York City over the next decade.
Okay, can you put this into perspective, though? I mean, is this basically a tiny fraction of the overall office space and employment in New York City, or is this taking on a sort of Silicon Valley 2 feel?
It's starting to take off. I mean, for now, financial services industry still takes on majority of the real estate here. Right now, financial services industry takes up around 30% of currently occupied space, whereas TAMI tenants, tech, advertising, media, information, take up around 24%. So there's still a lot more room for tech tenants to catch up, but they're starting to catch on, especially with these big leases coming into play. It's only going to continue to grow.
Is there a particular area? Because I know that Long Island City was sort of the place for HQ2 that never transpired with a lot of political pushback.
Lots of the tech tenants right now are kind of huddled around the new Hudson Yards area, the Chelsea area. Some of them are looking around Midtown Manhattan. These are all places where we're seeing that they're starting to come more and more so into Manhattan for now. Some are still looking at Brooklyn a little bit, but I'm not too sure about Queens.
All right, well, let's get to some consolidation, and Lisa Lee has been following that. We're seeing consolidation in the loan business, which I find interesting. Could you just give us a lay of the land as far as what we're seeing?
Well, we just recently had First Eagle, which is an asset manager with about $100 billion in assets, purchased TSL Credit Advisors, which is a direct lender and CLO shop. And Goldman Sachs just merged two of its BDCs, which are closed-end funds that lend to middle-sized companies.
So, Lisa, what's the advantage of these firms merging?
It's definitely scale, especially in the direct lending platform. The money has come in so much into direct lending that you want to be bigger, be able to underwrite and to hold the loans that you found. And that's definitely THL and First Eagle's thought process. And for Goldman Sachs in the BDC space, it takes their BDC to $3.3 billion and gives them greater diversity.
All right, and going forward, do we expect this to be an ongoing trend of consolidation, or are we pretty much reaching a certain sort of stasis?
Well, definitely mergers beget other mergers, and you can see more, especially in the direct lending space. In the CLO spot, partly this might be one-off, but especially in the BDC space, experts see this as a ripe industry for consolidations. The problem is that among BDCs, the quirk of the fund makes pushing through and agitating an acquisition difficult, but there's definitely room for more.
All right, well, nodding along here, Lisa, and thank you to you and all of our reporters, is Randy Schwimmer, who is Churchill Asset Management Head of Origination and Capital Markets. And he's been following, of course, the loan market and everything having to do with the space very closely. I want to start just generally, though, about the collateralized loan obligation landscape and the view into 2020, because we've seen kind of a soft year in terms of issuance as well as performance. What do you see for 2020?
Yeah, interestingly, I think we're going to have a little bit better start to 2020 than we thought ending in 2019. CLOs were hampered, especially on the broadly syndicated side, with CCC buckets being full and B3s being scarce in terms of not wanting to go CCC. And so what's happening now is they've been conserving cash over the last few months. And I think going to 2020, it looks like, based on some of the secondary price movements in leveraged loans, that there's going to be some room for them to start investing again. Not going to be a lot, but I think you'll see a firmer tone in the overall leverage market as far as the broadly syndicated market goes.
Okay, so this is not necessarily with respect to investors putting money into new CLOs, but existing CLOs are collecting cash from the debt that they're selling or letting run off, correct?
That's correct.
What about investor demand more generally for leveraged loans?
So I think as the market continues to firm on prices, which affects the assets that the CLOs are holding, I think that's going to be a benefit. One of the things that CLO formation depends a lot on is where AAA pricing, which is the liability side of the equation, goes. That's been on the higher side this year. It's hard to see where that's going to go next year, but I think that overall deals are getting done. We've at Churchill have done middle market CLOs. So I think there will still be room for CLO formation, which is a positive thing.
All right, you said when we were talking before this that you think that first quarter is going to be really active, in particular with sponsors bringing deals to market.
Yeah.
Why?
Well, I thought we would coast into the end of the year at Churchill and kind of have a nice holiday season, spend time with our families. Well, it's turned out that our deal flow has never been higher in the last couple weeks. And I think in part, talking to sponsors, there's a little nervousness about next year, particularly in the second half relative to kind of political risk and concerns. And so my sense is they're trying to get a jump on 2020. So the pipeline that we're seeing now is really geared to sort of January and February closings, which means I think they want to make up in time for what they think may be a bit of a slower second half or less certain. Anyway.
And when you say pipeline, you're talking about financings for LBOs or other types of
deals?
deals?
All kinds of private equity-backed deals. So it's refinancings, it's new platforms, it's add-ons, and we're seeing really the full range of those deals.
How are the structures, do you think, of those deals? I mean, are investors pushing back and showing discretion, or are you seeing things kind of getting a little frothy?
Yeah, we're actually pushing back on behalf of our investors because things are getting frothy. Our hit rate is less than 10% of the deals that we look at for that very reason. We're trying to be picky, and we actually are succeeding. So the leverage in the deals that we've been doing has been pretty consistent over the last several years. But yeah, we're on the alert for deals that are getting levered more than they should be, particularly some of the cyclicals, which still is something to be careful about.
One theme that you and I have talked about, and a number of others as well, has been that direct lenders have been taking over a greater proportion of the business once dominated by the leveraged lending area. That basically syndicated loans are getting pushed aside. Do you see that sort of accelerating as a trend in 2020?
Direct lenders are continuing to raise capital, and they're doing larger and larger deals, as you've commented really brilliantly on this show. And I think the thing that to watch out for is that as the direct lenders like ourselves get more capacity, the deal size is going to grow, and that's going to cut more and more into the syndicated product. It's also going to be interesting the second half of next year to see where the volatility goes relative to political risk, and if you start seeing more volatility and uncertainty as to where the overall public markets and liquid markets go, you're going to see the sponsors kind of going flight to safety, which in our case is companies that can get their deals done with a certainty of execution.
Randy Schwimmer, thank you so much for being here today.
Being with you.
Randy Schwimmer of Churchill Asset Management. Coming up, private equity is setting its sights on retail investors. We discuss that with this week's Power Player, Elizabeth Weindruck. She's Barings Managing Director of Alternative Investments. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. Private debt and equity firms have been raising record amounts of money in the past few years. We talk a lot about that. And now a growing number of investors are talking about democratizing the market. For more of a sense of what that means and what to look for next year, we're speaking with Elizabeth Weindruck. She is Barings Managing Director of Alternative Investments. Elizabeth, thank you so much for being with us. Can we start with what does that mean? Does that mean that everybody with a retirement fund is going to have private equity exposure?
Hi, Lisa. No, it's a very good question, and this is a topic that's been it's been top of mind for a lot of investors for several years now. And the primary reason is because private equity markets consistently outperform the public markets. And if you look at it over a 10 or 15 year horizon, you have an asset class that's generating very strong returns that has traditionally only been available to large institutional investors. And so I think there are a number of voices out there in the market saying we should provide access to these types of returns as well as this asset class in general to your general mom and pop investors. And so I would say that on the more retail side of things, there is a push to make this asset class available, but there's also a lot of risks involved with it as well.
Yeah, I was just going to say, I mean, a lot of people think that the best returns of private equity are gone. And the question of liquidity, right? The idea of people looking to be able to withdraw their money from retail funds and the inability to do that when it comes to private equity. I mean, how much of a risk is that? Do you see that as being an impediment, or people will just shrug that off?
I do see it as a risk. And so, look, I think that this is something that is coming, but this is not something that will take hold in the market in 2020 or maybe even in the couple of years subsequent to that. I think that you have issues around pricing, like liquidity, as you mentioned. But at the same time, I think that with more businesses staying private for longer, as well as outperformance in private equity. And look, I will agree with you that returns are compressing there, but you're still, over the long term, are going to generate outperformance when you do compare to the public markets.
Elizabeth, I want to shift gears a little bit to the dry powder that we've seen, because we've seen record amounts of dry powder accumulate. And I'm wondering, first of all, does this mean that private equity companies don't know what to do with their money?
No, I don't think that it means that. But I will say we've got about 1.2 trillion in dry powder that is that's in the market today, and that capital, it will get tranched into the market over time. And so private equity sponsors are raising capital and then they are investing it over a 5 to 6 year investment period. And so you have to think about it kind of coming into the market in, kind of in a more measured pace. And I would say the capital overhang is, it's a function of I'd say quicker fundraising timelines. And so it's taking less time to raise capital, as well as larger funds getting raised. So I wouldn't say that there's a problem in putting the dollars to work. The money's just getting raised and put to work more quickly.
Okay, you say it's getting put to work. I'm wondering if the money is not put to work, are any firms returning the capital or not? If they're not drawing on it to a certain degree, where does it go? Where does the money sit?
It's an interesting question. So I would say that we do not see issues in sponsors putting the money to work. There are ways where they can request extensions and give themselves a little bit of extra time to put that money to work. There are times when they could release commitments back to investors, but generally speaking, we're seeing a pretty healthy marketplace, and I don't think that there are issues in getting dollars out the door.
I would love your perspective on something Randy Schwimmer was talking about, which is the first quarter and being a really active one. Do you also see that people are going to try to get ahead of the 2020 elections in the United States and get deals done early?
So I would say within our portfolio at Barings, we're seeing a lot of deal activity, and we're seeing a lot of really interesting opportunities. I don't think that there's a rush to put capital out the door to mitigate any sort of future political risk. This is a long-term asset class. Money is getting put to work for a long time, and so if you invest the capital in January versus investing the capital in November, I don't know if that it makes much of a difference. I will say political risk is something that's getting talked about a lot lately, and so I think that as we look at deal flow and as transaction activity happens, I would say that amount of risk is probably getting priced in. So I don't see people rushing to put money out the door just to kind of avoid certain political pitfalls.
Elizabeth, just real quick here, is your sense that a lot of private equity firms are expecting some sort of downturn or down cycle next year?
So if I knew the answer to that question, then we'd be I'd be in a different situation. But I would say that we at Barings are talking about the fact that we're late in the current economic expansion. We're late cycle. We're seeing a lot of typical late cycle behavior that's happening when it comes to things like purchase price multiples, when it comes to leverage multiples. So I think that everybody is preparing for some type of downturn, but we're not quite sure when it's going to be. And so we have to think about where we're investing the money. And so we're seeing interesting opportunities in more defensive industries, and we're hearing the words, recession resilient a lot more as we're out in the market, and we're seeing deal flow.
Thank you so much, Elizabeth Weindruck from Barings. Now, we know that all firms are preparing for a downturn. Recently, we caught up with Goldman's chair of investment banking, Allison Mass, and she told us that private equity firms are bracing for just such an event.
Every one of our clients is focused on being prepared for a recession. And there's a different level of preparedness depending on their macro view. So on the one hand, we have clients who are just looking at their capital structures and saying, let me make sure that all of my capital structures are ready in case there is a recession next year, and my 2-year plan has to be a 4-year plan, or my 3-year plan has to be my 5-year plan.
Mass also mentioned that she heard of a recession checklist by one head of a private equity firm. But just because firms are preparing doesn't mean it's a sure thing by any means. In fact, there is, of course, the concern that they could suffer losses and then have a reputational risk. But there's also a political risk as they amass more and more capital. They don't want to be called out eventually as having been bad actors at the end of a cycle. Coming up, one whiskey collector amassing 3,900 bottles, including some rarities. Next, we tell you what price tag is being put behind them. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Family offices are mini investment firms set up by the rich, the super rich, to manage their personal wealth, and they are pouring more and more cash into direct lending. Bloomberg's Kelsey Butler joins us now with more. Kelsey, can you give us a sense of the acceleration that we've seen with ultra-wealthy families putting money in the space?
Yeah, so we've definitely seen a ton of family offices go into private debt for the same reasons that other people do, higher yields, and in a world where everyone is kind of stretching for that.
Ultra wealthy, they're just like us?
Exactly.
Okay, go on.
Exactly. So currently there's about 400 family offices that are active in private debt. That's up from about 130 in 2015. So it has been picking up steadily. Now family offices make up about 10% of the investor base.
Okay, and I'm wondering if there a particular geographic region where it's been picking up more? Are there any specific examples that you're kind of honing in on?
Yeah, so it's something that is going on globally. There was one family office which was a really big example in our story, Monaco-based Apollos, which is planning to invest $50 million a year in private debt. We see people, even former Los Angeles Dodgers owner Frank McCourt Jr., he's put money into direct lending, and even foundation trusts for Bill and Melinda Gates have put money into private credit.
And what do people think as far as the outlook for growth going forward?
So there have been surveys done by one of the biggest trade organizations for private debt that says that most people, or about 50% of private credit managers, believe that family offices will continue to put more money to work in this space.
And it's basically instead of stock investments, or is it instead of private equity? Do we have a sense of what they're swapping out?
So some of them are swapping out more liquid credit investments. Some of these are just using it as a way to diversify their credit portfolios, and others are using it as a way to kind of extend entrepreneurial efforts that they've already been doing.
Kelsey Butler, thank you so much for being with us. I want to shift gears to billionaire beat and to Hugh Grosvenor. He is the 7th Duke of Westminster and the UK's 3rd richest person, and considered by some of its people the most eligible bachelor. He is 28 and he is suffering some backlash right now. Bloomberg's Tom Metcalf joins us from London to explain why. Tom, he's 28 years old. How much is he worth?
He's worth about 12 billion, so yeah, that definitely makes him one of the more eligible young men in Britain. But he's having a rough old time with it at the moment. He's got sort of the political leaders attacking him. He's effectively seen as being sort of the embodiment of kind of everything that's wrong with the British economy. As you say, he's the 7th Duke. He's 28, he's got 12 billion, and that's largely from sort of inherited property. So a lot of kind of political leaders are seeing this as exactly what they're trying to stop in the economy, the idea of rentier capitalism.
All right, so please elaborate a little bit about rentier capitalism and exactly how this individual made his money.
So, well, it wasn't really him. It was, 6, 7 centuries ago, one of his ancestors got given a whole lot of land in London. So that's Mayfair, that's Belgravia, that's really the top tier of properties. And the family's been able to hold on to it ever since. And so today, that 12 billion is effectively the value of properties. It's how much they're making out of rent. And, the common criticism of that is, where's the value he's adding there? And that's what someone like Jeremy Corbyn, who's the leader of the opposition party here, has really been attacking him on, and just saying, is this fair that just by virtue of who your dad is or your great dad is, that you're going to be one of the country's richest people.
Well, and from a policy perspective, I mean, it's no coincidence that we're talking about this amid the UK election cycle, and I'm wondering how billionaires have been portrayed by candidates throughout the past few months.
Yeah, they really, from all sides, they've been kind of in the crosshairs. So, along with the Duke of Westminster, you had Jim Ratcliffe, who's Britain's richest person, attacked, Crispin Odey, and much like there is in the US, where there's a lot of chatter about a wealth tax, that's a similar sort of, atmosphere here, sort of an increasing dismay at sort of the rise of billionaires. In fact, you had the Shadow Chancellor, John McDonnell, saying, billionaires, no one deserves to be a billionaire. So very similar rhetoric this side of the Atlantic as across the pond.
All right, Bloomberg's Tom Metcalf, thank you so much for being with us. It is time for this week's big number. Sip on this. Next year, a whopping 3,900 bottle Scotch collection will hit the auction block, including some rarities that may sell for almost $2 million a piece. The trove includes an unprecedented number of bottles from storied names such as Macallan, Bowmore, and Springbank. As you can tell, I am not a huge Scotch drinker, but I will say this segment where we talk about the different auctions is important to just sort of highlight how ultra-wealthy individuals are spending their money in a variety of different ways, giving a sense of the feel in markets right now. That does it for us. Reminder, you can watch us each Tuesday, 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.